Here are some highlights from Richard Walker, a partner at Bain & Company, who's speaking at the Financial Markets Conference that I thought you would like to check out.
Coming to you, Richard, we're talking now about, a possible future with Web3. And so the question is, what would the transition look like? Are there going to be interim stages of adoption of technology like Web3, and what would they look like? And what do you think will be the key obstacles to further adoption?
Web3 and blockchain are general-purpose technologies. Web3 technologies have emerged and scaled through crypto, but will extend into new uses and new use cases going forward based on transformation of all aspects of finance. To understand where we are now, a parallel is the internet in early days emerged and scaled through gambling and vice-based activities. And while those activities persist today, the state of the technology then was weak. The belief that it can be something meaningful was low. But today, the internet has extended as a general-purpose technology to provide an amazing infrastructure for finance and commerce, and Web3 is positioned to do the same. Web3 companies have attracted $95 billion in investments between 2017 and 2022 across 4,000 companies. The functional areas covered by these companies include blockchain and platforms, core infrastructure, developer tools, financial market infrastructure, and user applications. The innovation over that 5-year period was significant and provides the foundation for what's happening today in the space. Now, God created the world in 6 days, but didn't have a legacy environment to support. Web 2 has been in development for 25 years, and we're now at a transition to a new technology stack, governance model, and process architecture that makes up Web 3. However, we're likely to live in a Web 2 environment for some time, and the change will be incremental and gradual as we shift to a Web 3 tech stack. For banking and financial markets, the disruptive thesis of Web 3 disintermediating parties in financial transactions is quickly fading. It's quickly fading as regulated entities engage with Web 3 and innovate around new processes, new workflows, and redefine the value they bring to financial intermediation. We're working on a report now about the future financial market infrastructure and have the following findings from interviewing and surveying over 50 market participants, including global banks, broker-dealers, exchanges, asset managers, and Web3 natives. The first point is that the future state infrastructure of financial services, validated by industry executives, will likely be delivered on shared, interoperable blockchain networks used by regulated incumbents. The second finding is that while this feels inevitable to the industry, there's still much to do as current state functionality, standards, interoperability, and regulatory clarity is not yet there for widespread applicability and use. However, financial services institutions aren't waiting, and distinct blockchain business networks are being delivered today, organized around use cases in jurisdictions with legal and regulatory clarity. Now, the journey to convergence of private and public networks, ledgers, and infrastructure stand to extend the value of those private chain business networks that are being developed today. So what we conclude in the report is that the near-term engagement by financial participants, financial market participants, is not about the right public or private blockchain. It's certainly not about crypto. It's about the right business network ecosystem and use case to gain experience and develop assets that will lead to accelerated adoption as the market matures, and doing so in a regulatory permissible way. Case in point, iPhone 1, not super functional, but you had to buy iPhone 1 and continue on that journey to get to iPhone 14. If you hear that the technology doesn't scale or other issues with the technologies not being very good, that's the way innovation cycles work. And market participants need to engage and use the technology so that it may mature rapidly and achieve its full potential in reshaping financial markets.
Sir, let me follow up to this question and stay with you on the next, as I open up the next block of question, which is benefits and use cases. So in your work, you are supporting major financial institutions understanding and leveraging technology for their own competitive advantage. From that vintage point, can you give us some practical example of use cases for financial services? And also, can you walk us through what would be the practical benefits for the average consumers from Web3?
Sure, Marina. There are myriad use cases that we're seeing, delivered, in the market today, in production. Again, largely on private networks, but there are a few examples of use cases delivered with public networks, such as EIB bond issuance on the Ethereum network. That example was a digital twin, if you will. So it was a traditional bond issuance, but they did a registry on the Ethereum network for the bond, and they've gone through 3 iterations of issuance as part of a program to understand, evolve, mature the technology, on their way to scaled use of it. Use cases that we're seeing include cross-border payments. Cross-border payments occur today using Swift. Swift provides the messaging. The messaging tells you what to do when it gets to the jurisdictional network for the settlement, but the settlement doesn't occur on that network. It still is very expensive and takes some time. And as Christine noted in her paper, cross-border payments for nostro-vostro accounts do tie up collateral, do have, which has an impact on liquidity and does carry with it counterparty credit risk. That can be eliminated through some of the use cases we're seeing in cross-border payments. Collateral management. A company called HQLAX out of Switzerland is a great example in a private network. They're using the Corda network to lock collateral in place through a tokenization mechanism and then using that token as a guarantee against the collateral so you don't have to go through the cost, expense, and cycle time associated with moving collateral from one custodian to another. We're seeing repo trading, intraday repo trading as a use case. Previously not possible because of the myriad steps associated with, posting collateral, holding that collateral, purchasing treasuries, holding those treasuries, liquidating treasuries, returning that collateral to the treasury department or a group at an institution who's executing the repo trades. We expect that repos will likely manifest in 3 8-hour windows per day to post lazy cash to earn a return, making much more efficient use of capital management by corporate treasuries. Syndicated lending. To originate a syndicated loan takes about 6 weeks because of the back and forth between organizations, the documentation, the cost of verification. There is a consortium of banks that have a network today to reimagine really the process, the cycle time, the collection of information, verification of information, and the ability to provide capital to organizations that need it. If you're an organization that's going to market for funding through a syndicated loan, 6 weeks could be a make or break kind of cycle time. Seeing other examples such as home equity on the Provenance network and mortgage origination. Later this year, Bain & Company, we have a company we own called Umbridge, which has developed a mortgage tokenization platform for Lennar Homes. And they will be tokenizing the mortgages of all new homes starting in the 4th quarter. The express purpose of this is to accelerate the mortgage cycle time so that you can provide that mortgage more quickly with greater assurance. And because it's against new homes, it effectively becomes a digitally native asset because of the ability to capture from the genesis of that physical asset, the home, all information carried throughout the life cycle of the home. So you would ask, how might this improve the experience of consumers? I would offer that, consumers and institutions both will benefit from this due to increased trust, transparency, and immediacy. From the bond example and the close cycle from a T+7 to a T+0 to mortgage origination, as well as the better use of assets held in households. Christine mentioned tokenization. In the future, I could see, everybody in this room having, a tokenized version of cars, homes, things of value, which you could use for posting collateral, just as institutions do. You could even use intraday repo types of transactions for your own capital management. So there's the examples of the use cases that can be delivered with this technology, and the benefits that it could realize are great. And the last point on this before I turn it over to my colleagues is, you might say, well, all of that was possible before, but the level of transparency, the removal of opacity, to Christine's point, the connectedness and the removal of friction, because you're not using a centralized database within an institution's four walls and exchanging data between institutions, which need to map to, institutionally unique, bespoke data structures, which often requires reconciliation and, a protracted cycle time. Sure, you could do that, but we haven't done it to date because of the cost and the operational risk and the diminishing return as soon as you have to invest that level using existing technology. So the things we're talking about are only going to happen with new tech on a Web3 stack. I think the current market technology, what the banks and financial market participants use today, is at end of life. The biggest risk is status quo. Hearing arguments for nothing to see here, move along, what we have is sufficient. I work with these banks. I work with these market participants. They've done everything they can to, performance engineer those platforms to support the level of market volume that they can. Large banks spend $10 billion a year or more on technology. My gosh, that can't be the most efficient way to deliver technology infrastructure. What you've heard up here over the last few minutes has been about decentralization in crypto, and my clients are in a post-crypto period. This has nothing to do with crypto. This is not about decentralization. As I said in earlier comments, the view is that there's a role for intermediaries, in this future architecture based on a Web3 technology stack. And it's very attractive to the market participants because of the end of life of current technology, because the current technology is what's opaque, corruptible, high cost, rigid, very fragile. We've seen that in consent orders to the largest banks around resilience. When a bank has a wires outage for a couple of days and the OCC issues a consent order to fix that, and that bank has to spend $1 billion to do it on current tech. Gosh, current tech's awesome. Seems to really be working well. Let's not change a thing. The highest risk is status quo. With regard to your keys, your crypto. In the crypto world, which I'm not talking about, but if I was to comment on it, code is law. In the application of a Web3 technology stack by regulated institutions, it's law as law. When you tokenize a real-world asset, a sovereign currency, real estate, a bond, law as law. It's less about custodying the private keys as it is about servicing that asset like you would a traditional asset. So, many of the arguments that you may have heard, or the perspectives, I would say, there's not arguing, but the perspectives, there's a chasm between what's really going on with the banks who are investing in building tokenization platforms, private networks, with the expectation that those private networks will be connected through public networks to create a network of network once the functional capabilities, regulatory clarity, scalability, and other factors are in place, and there's every confidence it will be, because Web 2 is a 25-year cycle. It took 25 years to get to a level of maturity that we enjoy today. And we have no expectation that Web 3 will happen any faster than that. In fact, it may take longer, particularly as you bridge and live in this Web 2.5 world for a period of time. So the space is still developing, but the orientation is post-crypto. The platform we believe that's going to monetize the next generation or the next level of investment in the Web3 infrastructure is the tokenization of private assets. There is $330 trillion in private real estate in the world. There's $90 trillion in private infrastructure in the world. There's $160 trillion of private debt in the world. There's $55 trillion in private company equity. There's over $600 trillion in assets that are not in the financial system. They're highly illiquid, not very serviceable, that are ready to come into the financial system to be regulated by or to be serviced by regulated financial institutions. What will that do? That will materially expand the financial system. Because when you bring those assets in and they're used as collateral for access to liquidity, you have to expand the monetary system. And it's backed by real-world assets. We've published a report around the interest in private investments. Couple of data points. Wealth is held today 50-50 by institutions and individuals. However, investment in private assets today is 85% held by institutions. Individuals would like access to invest in these private assets for diversification, and also because private investments have returned 5x public markets over the last 20 years. Based on our data, there's $8 trillion to $12 trillion in AUM positioned by private, high net worth, ultra high net worth, and affluent individuals to move into private investments of tokenized private assets. That $8 to $12 trillion will be the mechanism by which the next level of development of this technology ecosystem is monetized, the deficiencies are addressed, new capabilities are introduced, and the evolution of the tech stack and the re-expression of the financial market infrastructure will be realized.
Thank you. And let me ask everyone a final quick question before going back to Christine for her reaction to all these points that have been made. And I just would like to give you, a minute and a half each to answer the following question. If you were to recommend to policymakers, we have a room full of them today, one action to mitigate the risk to consumer and financial stability emanating from Web3, or one action to maximize its potential benefits, what would that action be? And let me start with Richard, and then Stephen and Hillary, and then I'll move back to Christine.
Thanks, Marina. As part of the report, again, the interviews and surveys with 50 market participants, largest in the world, around the future financial market infrastructure and how public ledger fits into that. We did ask in the survey, what is holding you back from moving forward? Overwhelmingly, the number one response was regulatory clarity. Number two is interoperability, and then scalability. But number one, by a good measure, was regulatory clarity. So there are two things that are needed. Regulatory clarity is one, and that requires engagement by folks in this room and outside of this room for public-private partnership with these institutions to help to create the structures, the guardrails, the clarity necessary for innovation to continue. It's happening internationally. It's happening in other jurisdictions. And, generally, the largest banks in the U.S. feel that the U.S. is falling behind based on what they're seeing advance in other jurisdictions around the engagement of this ecosystem. So regulatory clarity is one. The second thing, and this is really kind of like I know you said one, but 1B, would really be cash ledger on-chain at scale. And that, what's holding back the continued innovation, and private blockchains may have been invented 35 years ago. Not all old things are bad, and it takes some time for things to develop. For instance, the light bulb was invented, and it took 40 years before there were street lamps with light bulbs. So we're right on schedule with 35 years ago, private blockchains being invented, and we're about 5 years away from scale adoption. That's good news. But the thing that's holding back the transformation of the securities trading and of the DVP and really rethinking how you trade, clear, and settle. Similar to what's going on with the DLT regime in the EU to prove that trade, clear, and settle is a single atomic transaction, is a currency on chain to support that. So there are a number of experiments in play, but a tokenized deposit model would be a welcome gift to the growth of the ecosystem.
Okay. All right. So I'll start with you. You made the suggestion. Blockchain technology is not new. So why are there only 200 blockchains in existence? This is from Fimi.
I received a similar question about tokenization from a large European bank about, if it's possible, why hasn't we already seen it? It's because of the primitives that need to be put in place for the full potential to be realized by the environment. But why are we only seeing 200? In the survey that we did, we asked banks today, what do you use in the future in 10 years? What will you use, public, private, or hybrid, and how many do you expect to exist? And the majority of market participants believe that there'll be 15 or fewer blockchains. You don't need 200. You need, because it results in fragmented liquidity, which can be solved through network of networks and interoperability. But there'll be fewer blockchains in the future. There may be some smaller, special, fit for purpose blockchains. But the question around why we only see 200, I would answer because that's enough.